Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Bitmine Immersion Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's unpack this one. We have a really fascinating company on the table today, Bitmine Immersion Technologies. And from what I've seen, it's much more complex than just a typical tech infrastructure play.
That's absolutely right. The whole challenge here really is figuring out how you value a company that is essentially operating with two completely different identities.
Oh, identities.
Yeah. One is a fast-growing, patented infrastructure provider. The other is maybe the world's most aggressive corporate crypto treasury play.
It's a really compelling combination. And for you, the listener, I think you really need to understand both sides of this equation. The whole investment thesis is driven by how these two stories interact.
Exactly. We have to look at Bitmine Immersion Technologies as a business of two distinct parts. You've got the established cash flowing technology segment, and then you have this massive leveraged exposure to digital assets.
I think that dual identity is the key piece of context we need to establish right up front. It's not just some tech company that happens to own a bit of crypto on the side.
No, not at all. It seems to be structured to maximize high-growth tech profits, specifically to fund an aggressive strategic bet on Ethereum.
So the valuation is sort of pulled in two different directions then.
Precisely. On one side, you have the reliable metrics of the infrastructure business, revenue margin, cash flow. That stuff creates kind of foundational valuation floor.
A safety net.
A safety net, exactly. But on the other side, the stock is offering this high-octane leveraged exposure to Ethereum prices, which, can act like a booster rocket or a massive weight depending on the market.
Okay, let's ground this in the numbers from the infrastructure side first, because that feels like the foundation. Looking at the fiscal year 2025 results, the growth figures are, frankly, extremely impressive.
They really are. Revenue spiked by a huge 62% year over year, clearing $510 million. In an industrial tech sector, that kind of growth is it's just outstanding.
But the real story is what happened further down the income statement.
That's where it gets even better. Profitability. Revenue growth is great, but margin expansion is what really separates the winners.
And their net income didn't just crawl up?
Not at all. It jumped significantly to $89 million. And crucially, this pushed their net margin to 17.5%. That kind of margin expansion suggests they're benefiting heavily from economies of scale. They're getting more efficient as they get bigger.
And management seems confident this isn't just a one-off. They've already raised their forward earnings guidance for the next fiscal year.
Right. They're citing specific benefits from scaling up and some key new contract wins that haven't even fully rolled through the books yet.
So this momentum, it's all underpinned by their technological edge, their moat.
It is. They aren't just selling data center space, they're selling efficiency. Their competitive moat is built on proprietary immersion cooling systems, all protected by an expanding patent portfolio.
Okay, so when we talk about a moat, what's the actual, quantifiable advantage for their clients?
It's massive cost savings. The core insight here is that these cooling systems reduce data center operating costs by more than 40%.
40%?
More than 40%. Think about that in the context of AI or high-performance computing, where energy costs are your single largest variable expense. A 40% reduction isn't just incremental, it's transformational.
Wow. That sounds like an advantage that is extremely sticky. I mean, if you're running an energy-intensive operation, switching away from a technology that saves you 40% on power would be, almost financial malpractice.
It would be. And that's reflected in their customer retention rate. It sits comfortably above 92%. Once a client integrates this hardware, the technical barriers and the financial incentive, they just keep them locked in.
And that predictability, that stability, that must help offset some of the volatility we're about to get into on the crypto side.
It does. Let's look at the balance sheet. The tech business provides a huge safety net. They have excellent liquidity with $87 million in cash and equivalents, which, just dwarfs their total debt of $22 million.
What's the current ratio?
The current ratio is 3.4, which is a very, very robust figure. It means they could pay off their immediate obligations more than 3 times over with just their liquid assets.
That kind of financial flexibility is crucial. And they're generating cash too. $66 million in free cash flow over the trailing 12 months.
Right. And this brings us perfectly to the second, more explosive side of the business. That free cash flow from selling infrastructure is essentially being used to fund what a lot of people are calling the micro-strategy for Ethereum strategy.
That's a potent analogy. Let's break that down. Why Ethereum, and why is this so aggressive?
Well, unlike MicroStrategy, which famously went all in on Bitcoin, BitMine Immersion Technologies is focused completely on Ethereum. They've positioned themselves as the largest corporate holder of ETH globally.
And how much are we talking about?
They're sitting on a treasury of between 2.83 million and 3.5 million ETH tokens. When you add up the value of these digital assets and their cash, their total holdings climb up to an estimated $13.4 billion.
That is a staggering number. It fundamentally changes the risk profile of the stock. It's not an infrastructure stock anymore. It's like a huge hedge fund being run by a tech company.
Exactly. And their strategic ambition is maybe even more shocking. They have a stated goal of acquiring 5% of the total circulating Ethereum supply.
5% of the entire supply.
That's the stated goal. This isn't just a position, it's a strategic dominance play.
But is the market, specifically large institutional money, taking this seriously, or is it just seen as reckless speculation?
That's what's so fascinating. It seems to have institutional validation. This strategy is backed by major institutional investors in the crypto space. They see this as a calculated long-term accumulation play.
So for an investor, what's the bottom line?
The implication is clear. You're buying a stock that gives you extremely high leverage to the movement of Ethereum's price. If ETH rallies, this stock is going to be highly reactive.
Okay, so that's the core narrative. The profitable tech business providing the funding and the treasury providing the explosive upside. So how is the market reacting? What are the technicals telling us?
They're telling us a pretty clear story. The stock is in a very strong confirmed uptrend. It's trading consistently above both the 50-day and the 200-day moving averages.
And both of those averages are sloping upwards, which is what you want to see.
It is. It indicates long-term health and directional strength. We're seeing textbook accumulation, consistent higher lows and higher highs.
So investors are buying the dips.
Absolutely. They're viewing pullbacks as opportunities. Now, we do have to mention that implied volatility remains high, which can be, a bit intimidating.
Right. For listeners who aren't steeped in the jargon, what does high implied volatility actually mean in practice?
It tells you two things. First, the market expects big price swings, which makes sense for a stock tied so closely to crypto. Second, it's also characteristic of high-growth stocks in an accumulation phase. Big players are building positions, and that creates sharp moves. It's a feature, not necessarily a bug.
But you have to manage that risk.
You do. And on that note, we saw an interesting move recently. The company engaged Tom DeMark and his analytics team as a strategic advisor.
That's a subtle but powerful signal, isn't it?
I think so. Engaging a firm like his, which specializes in technical analysis and quantifying momentum, it shows that even as they execute this huge ETH strategy, management is prioritizing sophisticated data and risk modeling. It adds a layer of professional oversight.
And it's not just retail enthusiasm pushing the price up.
No, not at all. Institutional buying increased by about 11% quarter over quarter. That's a significant move of big money flowing into this name.
Okay, so what about near-term drivers? What are the catalysts we should be watching in the next few months?
The most immediate one is the Q4 and full-year earnings release. Given that they've already raised guidance, a beat on revenue or profitability will likely generate some serious upside momentum.
And it's not just about the numbers, right? There's hardware news coming too.
Correct. They're expected to launch 2 new products in their immersion cooling tech before the end of December. New products are critical because they reinforce that competitive moat and could lead to new contracts right away.
And then there's that rumor that keeps circulating.
The persistent market speculation about a partnership with a Tier 1 semiconductor manufacturer, that's the really big one.
If that happened.
If they partner to optimize their cooling for next-gen AI chips, it could drastically accelerate their growth and validate their tech way beyond just crypto mining.
And lastly, there are the more technical market dynamics, like potential index inclusion.
Right. As their market cap grows, the chance they get added to a major index increases. And if that happens, the rebalancing cycles, especially around December and January, could force passive funds to buy huge blocks of the stock.
Okay, we've laid out a pretty comprehensive bullish case, but a company like this, the risks have to be just as material. So let's dissect the potential pitfalls.
We have to. The single greatest risk is the source of its highest upside, the volatility from crypto exposure. This is not a subtle risk. It is foundational.
So if Ethereum has a severe, prolonged downturn,
The value of that massive treasury will drop dramatically. With a holding of 13.4 billion, even a moderate dip in ETH could wipe out years of profit from the infrastructure business. The leverage cuts both ways.
and they're not really in a position to pivot quickly if the crypto thesis fails, not with a goal of owning 5% of the entire supply.
Exactly. Then there's regulatory risk. And operationally, the infrastructure business, while profitable, does have some customer concentration risk. The top 5 clients account for 37% of revenue.
That's a big chunk if you lose one of those.
You'd feel it. It would create a material revenue shock.
And finally, there's just the sheer valuation. The sector itself is trading at elevated multiples, and BitMine's multiples are substantially higher than its peers.
So there's an overvaluation risk baked in. The market is pricing in near perfect execution.
It is. If growth slows even slightly, a rapid decompression of that multiple is a real possibility.
So to sort of wrap this up, BitMine Immersion Technologies is truly a company of two halves. You've got the sound, patented, high-growth tech operation providing a reliable revenue stream. And on the other, you have this massive leveraged treasury strategy that offers unparalleled exposure to Ethereum. The complexity is really the opportunity. For the long-term investor, you are betting on the durability of that proprietary technology to perpetually fund the world's biggest corporate bet on Ethereum. The core question you need to consider is how much value you place on the combination of a profitable, patented technology business versus being the world's largest corporate bet on Ethereum.
If you want more cutting-edge analysis like this, be sure to subscribe to Smart Wealth with Joshua.